All right, here we are on Wednesday morning, the day after our crop report, and what a useful report it was. Let me pull it up here for us to look at. Here's last month's crop report that the USDA put out, and here's this month's. And I'll save you the trouble of looking through them. They're exactly the same. Literally, the USDA didn't do any work on this report whatsoever. They left it identical from month to month. And uh, so a lot of people are like, well, they there must be nothing changed. Well, I don't think that's the case at all. I think lots of things are changing all the way across um, all the way across the marketplace. Now, I can show you beans, I can show you wheat, I can show you whatever, and they just didn't move the needle. And so what they did is just kick the can down the road to the March 31st planting intentions report, where they're going to give us, their first look on what our actual planted acreage is going to be, and they're going to give us a stocks update. So that report's going to be big, and I would definitely expect that report to be a very volatile event. Now, to say that it's bearish, I don't think is an accurate statement at all. So what I'm going to do is I'm going to dedicate a short video, probably later this week, and I'm going to send it out, and we're going to do some what ifs on the acreage and yield reports, and then we're going to make some assumptions too in that report on demand. Because the USDA continues to, let me pull this back up here. It's this number right here that the USDA continues just to leave where it is, and they're ignoring two huge things. Well, one is ethanol, and two is exports. They've raised them some, but they haven't raised them to keep pace with the purchases that we're seeing, and they haven't raised them to account for $70 a barrel oil either. I mean, guys, this economy is flying. Like, if you've traveled at all recently, the restaurants are full, the parking lots are full, people are driving nice cars. They are spending money like crazy, and so to say the market uh, is wishy-washy or whatever, I just don't see it. I mean, everywhere we go, people are wealthy and they're spending money like crazy. And so I don't see how demand is going to come down. It's like in the cattle market. The restaurants are full. That means there's going to be more steak. There's people spending and using stuff, and that means they're using more feed ingredients, more food, more everything. So I don't buy this in use number at all from the USDA. I think they're low on exports, and I think they're low on ethanol grind, and I think that they're really struggling with how they're going to reconcile that. And the other thing that they're ignoring, or maybe ignoring is a harsh word. The other thing that they haven't reconciled is the South American weather, right? You've got issues in South America, and I'm not going to jump too deep into that stuff, but from the people that I'm reading and listening to and talking to, the reality is that the South American corn crops are likely somewhere between 7 and 10 million metric tons. That's 350 million bushels less than what they say there's there. And the bean crop is off by the same amount, because you just can't have hot and dry weather and flooding issues and planting delays, and you just can't have all those issues compile on each other and maintain record yields. They didn't. The argument against that is, well, they planted so many acres. Well, I mean, I'm not an agronomist, and I'm not I'm not a farm operations guy, but I talk to you guys all the time. And when you expand acres, you expand marginal acres. You don't expand prime acres, and so that you're not going to get record yields off of that. And just the facts and the information that we're getting out of South America is just is just amazing. And I think the surprise is to the downside, not to the upside, as far as their crop size. So I think that's a bullish number. So I think that the USDA is struggling with how to reconcile all of those different variables. And then the bearish side says, well, China hasn't shipped all these bushels, and so they may cancel them and move them to new crop. Okay, they might, but they bought them in the first place because they needed them. They didn't buy them to be nice. They bought them because they're out and they need the food. And so at some point in time, they're going to take those bushels. And if they take too many from South America, then that just puts more pressure on our market, right? We've got to fill that demand from somewhere, because global demand is rising, not shrinking. All right, so we're going to put out a USDA video, and we're going to play with these numbers and just kind of have it interactive. I don't have time to do it in this setting, but I think it'll be helpful, because I want I want you to be thinking about, as these planted area numbers increase or decrease, and as this yield number increases or decreases, how does it affect this number down here, right? Because there's a relationship. And then on top of that, if we are, let's say, 1 billion bushels off between ethanol and exports and South American crops, what does that do to us, right? I mean, the fundamentals here could get really, really explosive if a few things happen. So let's look at how the market is actually digesting this. So this is your corn bean spread, okay? This is real simple. It's a chart that takes the price of November beans and divides it by the price of December corn. And what you can see is that it's contracting, right? We go back a year ago, and very clearly that the 2021 new crop spreads were saying, hey, we don't want beans. We've got too many beans, so we're gonna corn's got the advantage. Well, that all changed in April, and this spread got to be on a tear. And so now here we are trading at about 2.6. Remember, 2.5 is neutral, right? 2.4, 2.5, you can debate a little bit about exactly where that level is, but somewhere in this 2.5 is completely neutral. And when you start to run the economics, 2.6 is slightly favorable to soybeans. Well, that makes a lot of sense, because the soybean balance sheet is at 120 million bushels, and there's an argument that it's actually negative. And that might be what's causing the USDA to delay in reconciling these numbers, because I think if they put out what they really think is happening, I think it would shock everybody, because we'd have a negative bean carryout. And so the market's just sitting here coiling, right? See this price action, up, down, up, down, up, down. We're coiling, and we're running this little triangle right here, and the market doesn't know what it's going to do. So if this spread breaks out to the downside, that's bullish corn. That means that corn is gaining on beans, and that means that the market is implying, oh, we need more corn acres. If this spread breaks out to the upside, it's the opposite. It means that beans are gaining on corn and putting more distance on them, saying, oh my gosh, we've got to have more bean acreage. I have no idea how the market is going to reconcile that. Talking to guys, and my general understanding and feel is that a 2.6 number right through here is not enough of an advantage to beans to shift planting intentions. It's not enough to buy the acres that people think that they need. Because let's face it, you guys love to grow corn, right? It's fun. The bushels fly everywhere. It's a really pretty plant. It's fun to see it 8 feet tall or 10, and it's just good stuff. So it's got to be wider than this to take away from those corn acres, in my opinion. Then you start talking about, well, what about double crop? Well, okay, there you go. There's your marginal acre, right? It's really hard to double crop everything and hit 60, 70 bushel an acre beans. Maybe you can hit 30, 40, 50 if it rains a lot in Kansas. But the reality is, 20 is pretty common and pretty realistic if you're going to double crop beans behind wheat. So the idea that this spread isn't going to go anywhere from here, I think, is silly. It's going to move, but I don't know which way it can go. It's a triangle that can be explosive either way. So let's look at what our markets are telling us, right? Let's start with soybeans. What are we doing? Well, we've been working this triangle here that started in January, yet we finally broke out of it a week ago. We had this big nasty day on Monday. Then yesterday we reverse it and we have this move up. And now today we've got some nasty price action coming off of it. But yesterday was an all-time, or was the contract high close for all of the bean complex. Yesterday was the first day that we closed above the January peak. And so what should follow from there is a little bit of an expansion, a little bit higher move. Today's action, it's kind of bizarre, honestly. We don't want to see it drop below 1405, which would be, let me zoom in on this, give you a little clearer picture. We don't want to see it give up these lows necessarily, but again, when you start to break out on top of new highs, it's not unusual to have a false start. In fact, if I go back on this uptrend all the way back, the last $6 that we've gone up, it does it all the time. When it breaks a high, it tends to fade, and then it does it again, and it just continuously repeats itself. And so you get these big washouts that scare people, and they make them, and it feels unpleasant. In fact, it feels like we've been down every day for the last 60 days. It just doesn't feel like we've been in a rally. But guess what? We haven't gone anywhere at all, because with the balance sheets that we have, lower prices solve no problems. And if there's any takeaway from this market chat, it's that we're not going to protect our carryout and save supply by taking price, by making it cheaper to buy in a demand-led market with weather issues impending everyone else. So I think that this move extends. I think it extends on up to 1520 to 16, somewhere in that range. We don't know. We'll see how it gets there. If it does turn around and break, we don't want to see it break down this $14 mark. We'd like to see it hold it. If it does decide that it's going to break on lower, your buying points are 1380, your buying points are 1340, and your buying points are 1297. So unless we start to see that carry out, get back to 250, 350 million bushels, I think definitely breaks need to be bought as we go, because this thing's gonna more than likely just bounce and go, and you don't want to get knocked out too early. Now, these lower indicators, we do have the beginning of a divergence down here, which is fine, and so that's why we don't want to see this $14 level give way, because that would confirm this divergence and probably open up for a move a little bit lower. But for now, I think everything looks good on beans. I don't see anything too horrific. I think this break got to be bought, moving lower, just because of the overall balance sheet and the situation we've got. Okay, so let's look at corn, because corn's the one that really has us nerved up, right? I mean, we gapped higher Sunday night. Here's our Sunday night open. We gap higher a dime, and then by the open we're down a dime, and then we come back and we close it up. This was a 40-cent joyride given to us inside the corn market on Monday, and it was really nauseating to sit here and watch. But the reality is we're just trying to come out of this triangle, right? And there's just so much pent up inertia, and I think it's this prevailing psychology that we've had for the last 6 years, that the bull's got to be fed, right? If you read market analysts, they always say this: the bull's got to be fed. If he doesn't eat today, he can't run. Well, okay, that has been a prevailing thought for the last 6 years, right? If there's not a bullish fundamental during the session, we tend to trade lower. Well, that's not how these big bull markets end. We're going to end with some really crazy oscillations, and we're going to have huge ranges as we go. It's not going to be this neat and tight and orderly when we top this market out. So what's corn doing? We had a false breakout to the bottom side on this triangle last week. We have a false breakout so far today, and so far today we're holding the bottom side of this wedge. It's coming to an end. It's going to resolve itself one way or the other. And given the overall setup that we have here, it should resolve itself to the upside with a move to 590, 602, maybe even 625, 630, somewhere in this range. Because again, lower prices don't solve the problem. They don't help us, and they definitely don't go buy acres, right? If we look at new crop corn, where's my December? Here's my December. While May has been just kind of getting beaten up, new crop seems to be breaking out every single day to higher prices. We had an all-time high contract close for new crop corn yesterday. This market looks good and looks to continue to protect its acreage base. So I don't see how the soybean complex can be strong and new crop complexes be strong, and that new crop corn and bean ratio sit there and coil like we're doing and argue for lower prices. If beans drop on new crop, then corn holds and that ratio comes down. That's bullish corn. If beans rally because they've got a ration demand and buy acres, then that's going to pull corn with it, even if the spread widens. That's bullish corn too. So you just look at the whole piece, and the risk is to the upside, not the downside, minus these knee-jerk little reactions. And I think the final thing to really talk about is look at this MACD indicator here. And I'm running short on time, but timing analysis is really important. Markets tend to move in relationships, price relationships and time relationships. And if you look at this move and do the math behind it, we're just now getting to a Fibonacci time relationship back to the corresponding move up. And so when your MACD's been down below its zero line, basically since January 25th, all the way through here, this has all been showing a correction. This isn't typically where you see these things roll over and go down, because their time relationship to the prior moves has run its course. And so that's why we're so bullish coming out of this triangle, because we've sold off and haven't gone anywhere. We're trading identical levels to where we traded in January, and have softened these indicators to get into their buy zones and resolve these things to the downside without breaking price. And I think that's extremely bullish and consistent with what our weekly trend is telling us. We're still holding last week's low. We're still holding the 9-week moving average. We haven't broken anything on this weekly chart to make us think that lower prices are going to be coming. So for today, on March 10th, the best claim that we can make today is be patient. Don't rush to sell new crop for sure. Old crop, if you want to sell it, that's fine. I mean, there's no one's going to argue with you taking 550, 530 corn off the table. That's not stupid. But make sure that if you want to stay in it, that we'd be looking to buy dips to re-own it, because we want to go higher. New crop, I just don't see any reason to be making any big decisions on new crop this week, and we'll keep analyzing it and looking for it. All right, that is all I've got for you this morning. We will do a USDA video at some point this week as we kind of crunch some numbers and figure out what the best scenarios are to run by you. And that'll be an interactive sheet. And if anybody wants a copy of that, just let me know and we'll email it to you so you can make your own adjustments and see how that works as well. And we'll continue to watch it. And if something changes, we will let you know. I hope you guys have a great week, and I will talk to you later.